The world's auto producers and consumers are in the throes of a profound structural change, one brought to them by top-down government policy, says our chief equity strategist and economist John Blank. And he goes on to say in his recent writings that, in his economic outlook, that government actors are actively spurring a more rapid adoption of electric vehicles. In turn, they're spurring on the latest infotech sector technologies in chips and computer software and in chemical battery charging. John's here with me now to expand on all of this. It's a lot to take in. John, you say this is causing a factory floor revolution across all of the world's automakers. So are you referring to a structural change in the way this particular industry is going to be conducting business going forward?
Absolutely, Terry. And we got to watch Tesla because it's been the leader of this reformation of the factory floor as the leader of it. But now, for certain, because Tesla's a 12 or 15-year-old company and people left the company or people outside of it studied it, places like Volkswagen, GM, and Ford are not out of the loop on how to do whatever Tesla is doing. These factory floor revolutions are going worldwide. As we speak, they're probably in place.
So does this also go to climate change initiatives and economic globalization somehow?
It absolutely does directly. And Musk himself was the first person to realize that if he wanted to take on the sustainable world economy, which he talked about in his investor day with Tesla just on the 1st of March, is that he entirely aligned himself with the government policies that are going to bring about climate change. And the climate change policies that pertain here are subsidies to electric vehicles and all the back-end initiatives that need to take place. Not only do the governments like this from a climate change perspective, that they have grown to see that this is also going to help bring high-paying jobs into their economies. And that's been the double sale that works here.
So what does this mean for consumers exactly and the economy going forward?
It's interesting to say that and think about it a little harder. It means that eventually all of us are going to be in electric vehicles 10 years from now, which is both a strong statement and a weak statement because 10 years is a long time. But in 10 years, you should be preparing for owning an electric vehicle. I think that's what the government is telling you, 10 years from now.
Despite affordability issues?
Well, that's why I say 10 years from now, because you can be the late mover, late adopter, and have BYD build your dream, which is what the Chinese company stands for. BYD is build your dream. They are already pricing cars in China at $28,000 a year for Chinese automakers, and they're pretty decent. So that tells you that that's where the floor can be in all countries eventually. And I think that's why we may see, people waiting it out and getting better deals on either used Teslas or BYDs or Hyundais or Volkswagens or late cycle Fords and GM cars that are going to do better at lower prices.
And in the meantime, then, is this what happens regarding this sector now have material impact on any U.S. economic slowdown this year?
Well, this gets into the very nature of a confusion out there, which is this is called structural change, as we alluded to start. And what is going on with the Federal Reserve System in terms of rate hiking is called cyclical change. The Federal Reserve is bringing about cyclical change that has nothing to do with what we're talking about. But what's going on with all of this can moderate that cycle and change its dynamics dramatically. And that's what people need to understand. This is not cyclical change. This is structural change, and it will take place over the next decade.
Okay, you wrote on Monday of this week, I believe, the slate of macro data that is due out or was due out this week, as we're on Thursday now, March 30th, would show us just how much the latest market movements make both U.S. and global recessions more likely. So now that data is pretty much out, what's your thinking on recession based on that data?
Actually, market's up today, and I'll tell you why, Terry, because the Spanish harmonized inflation for consumer prices, the HICP, which is their version of the CPI, the consumer prices. The reason they do HICP is they harmonize it across countries and regions for use in the Eurozone. Spain reported first today. This is Thursday. The European Union will report tomorrow. But obviously, Spain is a part of that data, right? So what Spain came out with is they halved their core HICP because of the falling energy, natural gas prices in that part of the world. So this is really welcome news for stocks, and it means the ECB may not go as high as they used to think they were going with their rate hiking, and that's all good for the European economy, which means it's good for the global economy. And since the European Union is a trade partner of us, it's major. It also helps the United States.
Some have said that recession's odds have spiked after Fed Chairman Powell's remarks last week. Do you agree with that?
Recession odds have gone up because of the banking crisis, not because of what Powell said.
And so, in your mind or in your assessment, you don't think the FOMC is maybe overdoing it on the rate hike side?
No, I do not. I do not think they are, because I think, again, arguing purely from a monetary policy perspective, they typically like a 1%, what's called real federal funds rate, and they put 1% on top of what they consider the economy's consumer price inflation, which is called the core PCE, personal consumption expenditures. That one's the economy-wide one, not the one on the CPI. That's for the labor market and your Social Security thing. This is a different measure. It's typically lower. Right now, it's at 4.7%, the core PCE. So put 1% on that, and the Federal Reserve System, unless the core PCE comes down the next 6-8 months, will end up at 5.7% on the federal funds rate at the end of this year. So they're targeting 5.25 right now, which tells them they are already baking in a 0.5-point drop in the core PCE in the last half of this year. And that is not overdoing it. That is, being somewhat sanguine about the ability to bring inflation down just a little bit and staying at 5.25%.
So just how resilient do you think the global economy and markets are right now?
I think the global economy is implying some type of Chinese intervention, particularly in the manufacturing area. And we are seeing that, and that is going to help.
And impact on the markets then?
I think we're going to see more people get stronger in their motivations to pick up some of the small caps and some of the international names that kind of go together. That's kind of the global economy, and there's kind of a trade there right now.
Okay, let's look at a few large caps now. On the Zacks Strong Buy large cap stock list are Meta Platforms, Novo Nordisk, and Salesforce.
Yeah, so these are the big names. We all know these names. Meta Platforms, $205 a share today. Just want to point out, looking at the chart, that you could have bought Meta Platforms in early 2020 before the COVID pandemic at $200 a share. So Meta's done nothing for 3 years. The good news is Zuckerberg has gotten rid of a lot of employees, and he's taken its earnings estimates up from around $7.50 a share to $10.20 a share this year, and $9.50 a share next year. Is now at $12.60, just because he got rid of a lot of extra people inside the business that he had bought in during the pandemic. So Meta Platforms is a mega cap. It's a $532 billion stock, and you've got to remember the NASDAQ and the S&P they're going to keep this as a market weight index, so this matters more than any other stock. A $532 billion stock, if you think a large cap's $5 billion, this is basically 100 stocks that are large caps. So Meta Platforms matters a lot, and it matters 100. It's like 100 large cap companies. Novo Nordisk. This is a diabetes company. Fantastic chart. You bought this in 2019 at 50. You're now in at 156. You tripled your money. Only issue you got here is it's all priced in. I would probably stay away from Novo Nordisk because it has a one rank, but it has a very, very poor look on the chart. And I don't like stocks that are fully priced in. And that's certainly the case with Novo Nordisk. Salesforce. Chart looks a lot like Meta. Interestingly enough, both San Francisco companies, both are getting rid of people. And as a result, yes, Salesforce is raising its earnings. $577 this year has gone to $711. Next year, $695 has gone to $880. So they've basically thrown, next year, almost $2 a share in additional, a 26% increase in earnings next year. That's all for getting rid of people. So now the stock's at $197, and I'll just tell you the obvious thing. Being around $200 a share for Salesforce was the same price just before the COVID pandemic. So again, both Meta and Salesforce are just treading water over the last 3 years. But The good news is they are, again, market cap weighted index. This is a $200 billion stock. So again, this is probably 40 large cap names all rolled into one for Salesforce. We've got to pay attention to the stories that are unique here, that are in this market weight units, that driving it forward more. That is Salesforce, ticker CRM, and Meta Platforms, ticker Meta. Those two are the ones we're talking about today. They matter more than other stocks.
Okay, our chief equity strategist and economist, John Blank, on structural change in the auto industry and its possible effect on the global economy. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.